please do not feel to sort of speak out. If you have any questions, do not feel to interject and ask your questions. For equity market indexes, I'm sure you must have all heard of market index. I'm sure you must have all heard of S&P 500. I'm sure you must have all heard of the Nigerian All Share Index. So those are current indexes. So the S&P 500 is the index that covers the top 500 most capitalized stocks in the American market, while the Nigerian All Share Index covers all the stocks that trade on the Nigerian Stock Exchange. So the whole essence of this reading is to make you understand what market indexes are. Why do we have market indexes? What are their objectives? How do we create them? How do we make use of them? What are their uses beyond, or rather, why are they created? How are they created? What are their different uses? And how we can incorporate them into our world of investing. Yeah. So this is the most simplest way to define a market index. Yeah, a security market index were first introduced as a simple measure to reflect the performance of the US stock market. Yeah, so the first time security market indexes were introduced were as a result of performance. Wanted to see how the market performs. That's the primary reason why market indexes are created, to be able to sort of the performance of a particular market, performance of a particular sector, performance of a particular industry. So if you're conversant BBC or see where maybe when they are giving their market news, you see all those indexes, and when you see green triangle facing up or a red triangle facing down. Yeah. So everything regarding to that are market indexes. Yeah. That's everything about market indexes. Yeah. And a lot of people always say it can either be indexes or indices. I like to call it indices actually than indexes. That indexes just feels a bit, sort of weird. Okay, so let's jump right into it. Identification, index definition and calculations of value and return. So when you look at CNBC, yeah, and you see that figure, they will say S&P 500, 4,200 and something, and you now see a green triangle, they will now put 3% on it. What does that all mean? That's what we're trying to explain today with this section. Yeah, with this section, that so that by the time you go back to CNBC and you're looking at all those figures and you're hearing the person talk, you can understand what the person is talking about. So what is a security market index? A security market index represents a given security market segment, asset class. So it's a representation of either a market segment or a sector or a particular asset class. Most indexes are constructed as portfolios of marketable securities. Meaning, what we're trying to say is, if you look at an index, I will always tell people that an index is an hypothetical portfolio. Now, you all know what a portfolio is. A portfolio is a basket of securities. So an index is a basket of securities. Those securities that make up that index are what we call constituents. So when you hear the constituents of the index, what they are talking about are these various securities that make up that index. So in a simplest form, when you hear a market index, think about it as an hypothetical portfolio that contains different securities. And these different securities are called constituents. Yeah. So depending on what market or what segment or what asset class that security market is trying to represent, it is that representation, meaning the securities that are in that security market or are in that market segment or make up that asset class that now form the constituents of the security market index. Now, your security market index, for each security market index, investors may encounter two versions. So there are two versions of security market index. Number one is called the price index. Number two is called the total return index. Now, what do we mean by price return index, or simply called price index? A price index is a market index that considers only changes in price. Now, if you go back to my former representation, my former point that I made, I said the primary objective of a security market index is to determine the performance of a particular market segment or asset class. So what it's just technically saying is the whole essence of a market index is to show us the performance of the market that it represents. Yeah. Now, when we talk about performance of securities, it can either be price or it can either be total. Yeah. Now, what do we mean by price? Price performance means performance as a result of changes in price. Either price goes up or price goes down. Now, if a market index is measuring the performance of a security market, and that price index is just a price, or that market index just focuses on price returns, then it means that the changes in the price of the constituents is what is pushing the change or the performance of the index. Now, when we now go to the other side, which is total return index, when you hear total return, we're talking about not only changes in price, but also in dividends or income. Looking at the whole total picture in terms of performance. When you invest in a stock, you are not only after capital gains, you are also after what? You are also after what? Dividends. So your total return covers both dividends and prices and changes in price. So when you have a market index that represents a security market, and it tell you that that market index focuses on total returns, what should come to your mind is that we are not only looking at price changes in prices of the constituents, we are also looking at the dividends that the constituents also pay. So technically, at inception, which is what they mentioned there, at inception, if you have two market indexes, one focuses on price return and the other focuses on total return, and they are both focusing on the same market, at inception or at the first start or inception of those two indexes, the value and performance of those two indexes will be the same. But as you move along, the total return should have a higher figure or a higher return than price, because price is just one element, while total return is both price and dividends. Yeah. Okay. Let's look at how the value of each version of the indexes are calculated, are determined, which is what we have here as the value of, what you have here is the value of a price return index. So the value of a price return index, I always tell people, as simple as it is if you know how to calculate the value of a portfolio, which is the market value of each constituent multiplied by what you have here as the numerator is summation of market values. So you determine all the, so let's imagine the index has 10 constituents. That means the market value of all the 10 constituents. And when you say market value, what do we mean by market value? Market value is number of shares, number of outstanding shares, outstanding shares multiplied by price, multiplied by market price. This gives you your market value. Yeah. So for each stock, you determine the number of stocks that they have multiplied by their market price at that particular point in time to give you their market value. Then you sum all the market values together to get your total market value. Sorry, apologies once again. So this now gives you your total market value. Now, your total market value is the same thing as this what? As this numerator. Now, to now get the value of the price index, you now have to divide it by a divisor. Now, this is where they talked about what we call a divisor. So a divisor is a number initially chosen at inception. Yeah. Now, let me explain what the divisor is. Remember that at inception, what everybody will always want to have is to have the market value of the index to be equals to a given number that we all know. And that given number, most of the time, is always either 1, 100, 1,000, pretty much around these three. But pretty much nobody really uses 1. So I would say it's definitely always around 100 and 1,000. So people always want their beginning value of their index to either be 100 or 1,000. Yeah. Now, the question you now ask yourself is, at the beginning, if I want the value, this value here to be 100 or 1,000, let's use 1,000, what would be the amount or the value that I will divide this total market value such that when I divide it with that value, I would get what? 1,000. So what some people will say in mathematics is change your formula. Yeah. So you just do your D is equals to your total market value divided by 1,000. So whatever this answer is becomes your divisor. Now, what do we mean by divisor? Throughout the life of the index, for this point that I'm saying, just hold this point in one hand. Throughout the life of the index, given that nothing happens, let's just put quote, nothing happens. Every day that you determine, because most times you have to determine the market, you have to determine the value of the index every day. So every day as you move along, yeah, and you determine the total market value of the constituents every day, you have to always divide it by whatever you calculated here as your divisor. So let me explain. So let's say day 1, my total market value for analogy 6 is 10,000. Yeah, analogy 6 is 10,000. And I want my market value at that day 1 to be 1,000. So that means my divisor in day 1 that I have used is 10. Now, that means day 1, my market value of my index is 1,000. Let's now say in day 2, my total market value jumps to 1,000, 10,200. That means for me to determine the market value of for me to determine the value of the index in day 2, I have to divide it by 10. That means my market value at day 2 becomes 1,020. That means in day 1, it was 1,000. In day 2, value of the index is what? 1,020. That means if I want to calculate the return of the index, you know, I've calculated value now. Day 1 value is 1,000. Day 2 value is 1,020. That means the return of the index in day 2, at the end of day 2, will now be what? Market value. So return of the index in day 2 will now be value of index in day 1 divided by value of index in day 2 divided by value of index in day 1 minus 1. And that's technically going to give me, that should be, if I'm not mistaken, that should be 2%. So 2% return between day 1 and day 2. So the point I'm trying to drive out here is that divisor of 10 is what you consistently use until something happens. Don't worry, we'll get to a place where your divisor, get to a place in the curriculum where the divisor changes. But as where we are now, that divisor doesn't change. We keep using that divisor. So all we just keep doing every day is calculating the market value of what's that thing called? The market value of the constituent is what we'll just keep calculating day in, day out, and we dividing it by our divisor to be getting the value of the index day in, day out. And the returns on a daily basis is just today's value divided by yesterday's value minus 1. And you keep doing that week in, week out. Yeah. And which is what the curriculum has said here already. Yeah. That's what the curriculum has said here already. I'm with you.
Yeah. So you said D is equals to the total market value over 1,000.
No, D is equals to divisor.
No. Okay.
I said yeah. What I said here
yes.
is
if
you want to
that's the part I
determine.
want to understand.
Okay. Do you understand this part? This is the formula. This is the formula.
Yes.
But remember that your divisor is whatever value that your total market value will be divided by in order for you to get what you have determined as your initial value of the index. And in this case, if I use my initial value of the index as 1,000, then it means that if I go back to this formula, I am asking myself at the inception that what would I divide the total market value by in order for me to get 1,000? Whatever that value is becomes my divisor, and that divisor is what I will use forever.
Okay.
Yeah. Does that make sense now?
Yeah, it does.
Yeah. So we have touched on this already, and which is why I said, how do you do this? Is calculating your market value on a daily basis and calculating your return on a daily basis. Yeah. And that is what we have done. And that's what the curriculum has explained to us here. So we can move, jump and pass. But let's go back to this. Total return. Remember that when I spoke now, Remember that when I spoke now, I just talked about total market value. And if you come to this point, I said your market value is your number of shares multiplied by what? Market value, market price. Total number of shares of each constituent multiplied by their market price at a point in time. Yeah, gives you your market value. By the time you add everything together, you get your total market value. So in this case, what changes your market value of your constituents every day is their market price. As their market prices are changing in the market every day, it changes their market value, their individual market value, so that by the time you sum it up, it changes the total market value every day. So really, what is really driving the price return index is just the market value of the constituents in the market value of the constituents on a daily basis. Now, but when you talk about total return, that means you need to incorporate what they paid as dividends. You need to incorporate what they paid as dividends. So that means if dividends is not paid, their market value. So instead of you for total return, let me go back. For total return, instead of you using only market value, you are using market value plus dividends for each constituent, and you sum it up to get what your total market value plus dividends is going to be. And that is what you are going to divide by your divisor. That's the difference. So every day when you go into the market, you have to go and be checking the stocks that have paid dividends that day that are part of the constituents. As any of these constituents paid dividends today? If the answer is no, then there's no dividends to add. The next day, you keep doing that every day. And now the trick is that all the constituents will technically not pay dividends at the same time. They will technically not pay dividends at the same time. So as long as they've paid dividends, you have to incorporate that dividends into your formula. So the point I'm driving at here is for price return, you are using only summation of market values divided by divisor. For total return, you are doing summation of market value plus dividends divided by divisor. That is the difference between your total return and your price return indexes. Yeah. So on a daily basis, as you are calculating the market value, you are calculating the returns. And return, like I said, is value of the index in day 1, in day 2, minus value of the index in day 1 in period day divided by value of the index in day 1 or period day. Yeah. Or I prefer to use V2 divided by V1 minus 1. It gives you the same thing. It gives you the same thing. Yeah. So that is how you calculate your return every day. So now I'm telling you now for a simple fact that let's don't complicate matters. So what the curriculum has done is the curriculum has tried to sort of give you different ways of calculating it. But I always tell people that don't complicate yourself. The easiest way is calculate value today, calculate value the next day, do your return. Calculate value the next day, do your return. Calculate value the next day, do your return. So now, when you go to CNBC, and when you go to CNBC and you see S&P 500 and you see a value 4,000, what this 4,000 means is that this 4,000 that you see here is the index value as at that day. Then you now see a triangle. If the triangle is facing up and is green, it means that automatically telling you that the index was positive that day. They will now give you maybe 0.5%. This is what? This is the return as at the return that the return that the index has done for that particular day. And with the few points I have made now, I believe that you should be able to calculate, you should be able to determine or know how they arrived at this value and how they arrived at this value. And the S&P 500 is a what? Is a price return index. Hardly do you see total return index. Hardly. But this is the price return index. There are not a lot of total return indexes.
So thank you, sir.
You wanted to say something?
Yeah, Tosin.
How are you doing, Tosin? Go ahead.
Yeah. So to break down this S&P illustration that you gave to us, right? So am I right if we say that this is 0.5%, this green arrow, right, going upward, giving us 0.5%. It means that the previous day we have the previous day index is less by 0.5% to this 4,000.
Bros, why are you trying to complicate matters for yourself? If I may ask. Why are you bothered about? Why are you bothered? That's what I'm saying. Your explanation is correct, but is complicating things for yourself. You are getting my point. Don't try, and I always tell people a lot. Simplicity cuts it out. Yeah. So you are right, no doubt about that. But it's what you have said by yourself. Even I'm sure as you were saying it, you realize that what you were saying was complicated. Do you know what I'm saying? Why are you bothered about yesterday's price? They've told you already that today the value is 4,000, and the green arrow is showing you that it is positive, and they've told you that this return that is there is positive. So that means automatically the index value today was higher than yesterday's value.
Oh,
but the way you said it was, that means that yesterday's value is lower than today's. Forget. today's value is greater than yesterday's value. Simple. But you are starting from yesterday to figure out today. No, today. Use today to figure out yesterday, not yesterday to figure out today. Does that make sense?
Okay. So
Yeah.
we just know that yes, today's one is greater than yesterday one. Simple. Today's one is 2,000. And the market has done better by 0.5%.
Simple, Mr. Tosin. God bless you. I can hug you right now.
Thank you.
You see how simple, when you now said it now, you see how simple it is. Even in your mouth, it came out without you feeling that I'm saying something that is complex.
Exactly.
Bam, that's it. So don't complicate yourself. Always look for the simple way out to explain things. Yeah. So, yeah. Any question? Any other question before we move along? Any other question? So everything here, like I said, is just them trying to sort of elaborate and put some things into color. I've delivered it to you guys as simple as I believe it should be. I won't say that the curriculum is complex, but I'm just saying that all these ones that they are putting here is just, as long as you know how to determine as long as you know how to determine what this value is, and you know how to calculate return. So all you just do is determine this value for yesterday, which you have done already, determine the value for today, which you have done already, and calculate your return. That's all. If regardless of if it is price index or total return index, is the same thing. Any other methodology that is given, there are a lot of methodologies. Any other methodology that is given is too much information. Simplicity. One thing you should learn about this exam is, as long as you can figure out the most simplest way to answer that question, please stick with it. No matter how much you want to complicate the question, simplify it for yourself. So all these things are just, like I said, good to read. You can read it at your own time, but it's just too much for me, too much information. Okay, calculation of index value over multiple periods. So what are they trying to say here? Is to say, imagine that I have day 1, day 2, day 3, day 4, and day 5. Remember that I have calculated the return on day 2 versus day 1. Yeah, I've calculated the return of day 3 versus day 2. I've calculated the return of day 4 versus day 3. And I've calculated the return of day 5 versus day 4. So technically, over this 5-day period, if it is Monday, Tuesday, Wednesday, Thursday, Friday, I would have 4 returns. So return in day 2, return in day 3, return in day 4, and return in day 5. Where return in day 1 is value of the index versus value of the index in day 1. Return in day 3 is value of the index in day 3 versus value of the index in day 2. Return in day 4 is value of the index in day 4 versus value of the index in day 3. While return in day 5 is value of the index in day 5 versus value of the index in day 4. Now, somebody can now come to you to ask you that, what is the value of the index over this 5-day period? Meaning, over this week, what was the return? Sorry, what was the return of the index over this 5-day period? Yeah, you now do something we call chain linking, which is something I'll teach you again in portfolio management, called chain linking. This is not how my handwriting is in real life, but don't worry. So what do we call chain linking? So if somebody now says, what is the return over 5 days, over the 5-day period? Yeah, over the 5-day period, then we'll now do what we call chain linking, which is equals to 1 plus return in day 2 multiplied by 1 plus return in day 3 multiplied by 1 plus return in day 4 multiplied by 1 plus return in day 5. Yeah, then everything I get here minus 1. That is the formula. And that is the formula that they've given us here. Now, if you now want to say, if they now, so what they've now done here again is to say, whatever you calculate here, if you now want to determine the value of your C, you already have value in the 5 sharp, but that's the whole logic. So this is how you calculate your return over multiple periods. Yeah. So let's now imagine what they're trying to do here is, let's imagine that you never had the values. You just had the value in day on Monday. And you just had only value of the index on Monday. Yeah, you only have value of the index on Monday, but you don't have the value of the index on Friday. But you had all these returns. Somebody should now ask you, what is the value on Friday? All you do is, the moment you calculate what this return is, you just do value on Friday is equals to value on Monday multiplied by 1 plus return over 5 days. Return over 5 days. And you will get your value on Friday. Yeah. So that's everything that they're talking about here. Nothing more, nothing less. Please ask your questions if you want explanation. But that's everything that they've talked about here.
Yeah, please can you repeat this last one?
Which part? Which part am I repeating?
This last one, value on Friday.
So by the time you calculate your return over 5 days, yeah, that's what flows into this that is here. So your value on Friday is equals to your value on Monday multiplied by, into bracket, 1 plus the return over 5 days, bracket close. That is it. That's how you get your value on Friday. And that's what they're trying to talk about here. That's what they've said here. Okay, so index construction. How do we, remember I told you, now we understand, I like this part. Yeah, I like what has happened here. And you guys will agree with me. At this part, nobody will go to CNBC and will not understand this thing. If you go to CNBC and you see these things and you don't understand it, then you have to come and reach out to me. Yeah. But against that, how do we even construct this index? So I can come to you and tell you, please construct an index for me. Let this index focus on a particular segment. Yeah. Let this index focus on a particular segment and monitor that segment by the construction of that index, by monitoring the performance of that index over the next 1 year, and tell me and give me a feedback. Now, the question is, how do you now construct the index? So people are saying that if you are constructing an index, you have to ask yourself these questions. Yeah. And you must have an answer, because these questions direct how your index will be constructed. So number 1, what target market should the index represent? Remember when we started, I said a market index represents either a market, a section of the market, or an asset class. So in this class, let us ask a question. What target market should the index represent? Question number 2, which securities should be selected from the target market? Do you want all the securities in market? Do you want a certain portion of the market? Or do you want a certain criteria to be fulfilled before somebody can pass, before a security can pass to be a constituent of the index? That is question number 2. Question number 3 is, when you now have these constituents, how do you want to weight them? Remember, how do you want to weight them? Because that would determine a significant aspect of how your index is going to be valued. Yeah. Number 4 is, what is your rebalancing policy? When should the index rebalance? Remember that you have identified or determined the weighting. Yeah. And as in portfolio, as the index is going over time, is moving across with time, weighting is going to differ from what you have determined. So you have to rebalance. Yeah. Then lastly is, when should the security selection and the weighting decision be re-examined? Meaning, when do you reconstitute your index? When do you determine if a security or a constituency does not meet those parameters again, and you need to remove them from being a constituent? Those are questions that we need to ask. And the next section sort of addresses each one of them. So let's go. Okay, so target market addressing this part is addressing these two, yeah, target market and security selection. So the first decision before you even think of anything, the first thing you need to ask yourself is, what do I want to represent? What do I want this index to represent? What is the target market? What is the market segment? Is it an asset class? What do I want it to be? So your target market may be defined very broadly or very narrowly. It may be based on asset class, either equities, fixed income, real estate. It might be focused on a particular geographical region. So are we looking at the world? You know, there's a world index. Yeah, the MSCI World Index. It covers all the markets, equity markets in the world. Or you want to just focus on only Nigeria, or you just want to focus on only America, or you want to focus on Africa excluding Nigeria. So you have to determine that. Yeah. Then the exchange on which the securities are traded. Should it be Nigerian Stock Exchange? Should it be Tokyo Stock Exchange? You know, in America, there are different exchanges. There's NASDAQ, there's Nigeria, there's NASDAQ, there's New York Stock Exchange. Which exchange? Yeah. Then what are the characteristics? Company size. I might decide to say, I want only, like now, look at the S&P 500. It's just, so if I look at the S&P 500 now, you will see, answering these questions, it is focusing on equities. It is focusing on American markets. Yeah. It is focusing on both the NASD, the NASDAQ, and the New York Stock Exchange. So it doesn't have, it's not focused, it's not segmenting markets. So it's looking at both markets. Then you now go to characteristics. It now ends it with what? Company size. To say you must have a market value that is among the top 500. Meaning that if we look at all the companies in the American market and we rank them based on market value, we are focusing on only companies that are what? That are amongst the top 500. So the moment you drop out of it, you are not going to be part of the S&P 500. And if you have been following the American market, you must have heard the story of who? You must have heard the story of Tesla. It took Tesla a lot to become part of the S&P 500. You know, there were a lot of back and forth, you know, and all that. Some people said, oh, let's bring another criteria if you are not profit making, you know. And
I can't
people start asking, sorry? Hello? Somebody said something, Mr. Abiodun. Okay, think out. Let me continue. So it took Tesla a lot to become part of the S&P 500. So if you follow that story, you would see that this was the reason why Tesla couldn't enter was because of the criteria in terms of the target market that the guys that created S&P were following. Yeah. So that answered your what? Target market and security selection. Now, the most important thing, like I mentioned, is index weighting, which answers question number 3. How do you weight your index? Yeah. Now, they are different from what I can see here. there are different ways you can index. Either you use price weighted, you use equal weighted, you use market capitalization weighted, or you use fundamentally weighted. So there are 4. And what we are going to talk about now is I'm going to look at each of those weighting styles and their advantages and disadvantages. So let's go. So the curriculum says the simplest method to weight an index, and that is the one that is used by Dow Jones, is what's called price weighting. Price weighting. Now, let me explain. For some people say, what is this Oga talking about? Yeah, but don't worry. As we move along, it's going to get clearer. Now, let me explain. Let's go back let's go back a bit so that at least some of you will not crucify me. Now, there are different ways of calculating the return of an index. There are different ways of calculating the return of an index. And the one I showed you, like I said, is the easiest and the simplest. You never fail. But some people always go through the route of saying the return on an index is based on the weighted return of the constituent. Now, what do I mean? So let us say that our index has only 4 stocks, A, B, C. Or let's say 3 stocks, A, B, C. And I want to calculate the return for today for the index. What do? I calculate the return of A. I calculate the return of B. Call that return of B. I calculate the return of C individually. Yeah. Now, I now multiply them by what? The weight of A. Multiply this by the weight of B. Multiply this by the weight of C. Then whatever I get, I sum that up. So I can say the return of the index is equals to the summation of the weight of each constituent multiplied by the return of each constituent. Summing it up together. That is what the return of the index is. Now, you can actually calculate. Now, this return that we're calculating here is daily return. Remember, I'm trying to calculate the daily return of the index. So this is daily return of each constituent multiplied by their weight. Now, this weight does not change. Yeah. And whatever you get, you sum it up and you get the return of the overall index. Now, to me, this is a more complicated method than what I gave you before, which is calculate the value of the index in day 1, calculate the value of index in day 2, and calculate your return. But here they are saying, forget the value of the index, calculate the return of the constituents, weight them, determine their weights, multiply that return by their weight, and sum. Once you get that, you can see which one is more complicated. But anyway, I had to explain this to you guys so that you guys will understand when I start talking about what? Weights. Now, how do you determine these weights that I have mentioned here is what we're now going to start talking about now. How do you determine these weights? Number 1 guy says price weighting, meaning they are weighting based on their prices. Meaning, remember that we had A, B, and C as our index, hypothetical index. So they are saying, in order for you to get these weights that we mentioned here, you use their price. And how do we do that? We go at the start point and say, at the inception, when we're creating the index, that's the inception, we'll say, what is the price of A plus price of B plus market price of C, sum everything up, it gives you your total market price for each one of them. So hence, the weight of A will now be what? Market price of A divided by the total market price. That is what they've explained to us here. So you do that for B2. B will be what? Price of B divided by the total market price. C will be price of, so you do that for all the constituents at inception. So day in, day out, what you're just doing is, because this is a given at inception, because this is a given at inception, so what you're doing day in, day out is what? You're calculating the return of each stocks. You're calculating the return of each constituent, calculating the return of each constituent, putting it into your Excel. This Excel will give you what this value is. You sum. That already gives you the return on the portfolio. Return of the index. So that's what price weighting methodology is about. Now, there's a problem with price weighting methodology. Yeah. So they're saying that, look at what they wrote here. The value of the price weighted index is determined by determining the sum of the current values divided by the divisor, which is what I mentioned to you at the beginning, which is typically set at inception. Remember that this divisor I mentioned. So you have set this divisor at inception. But remember when I was talking about that divisor, I said at that point, let us imagine that titi lai forever and ever, you will continue to use this divisor. But when you come to a price weighted index, meaning that if you are using a price weighting for your index, you now run into a problem. The problem you run to is when the portfolio, when a stock in the index now does what we call a stock split or a reverse stock split. Now, what is a stock split? A stock split is a situation where companies do this thing where I might be too pricey. Let's say, for instance, let's look at Nestle now, Nestle Nigeria or Seplat. Seplat is almost as high as 1,000 and something or 2,000 and something. The last time I checked, let me even check what Seplat is. Apologies. What's the price of Seplat right now? Hold on. What is the price of, why is this system hanging? What it is as high as 3,000 naira. Interesting. The last time I checked Seplat was barely above 1,000. Seplat is now 3,000 naira per share. Way. Okay, so Seplat now is 3,000 naira per share. Yeah, it is too expensive for people to buy, for a random man to buy it. So how do we make it cheap? Let us say that the market value of Seplat, meaning, remember what market value is now. Market value is your number of shares multiplied by your number of shares multiplied by your market price. Now, I am saying your market value, for instance, is 3 million naira. Yeah. And your price is 3,000 naira. That means your number of shares is 3,000 shares, because it's only 3,000 shares that you can, 1,000 shares. It's only 1,000 shares that you can multiply by 3,000 naira that will give you 3 million naira. Yeah. But this 3,000 naira per share is too expensive. So what do companies do? Companies carry out what we call a stock split, where they reduce the price by a significant amount. But you see, I reduce my price by a significant amount, holding my market value constant. So how do I do that? How can I achieve that? If I make this guy fall and I want this guy to be constant, then it means that my number of shares must increase. Yeah. So what do companies do? They carry out a stock split. So they can split this stock by 6. So that by the time you do 3,000 divided by 6, you have 500 naira. Now, in exchange for that, they now tell their shareholders that for every 1 share that you now have 6 shares. So that this can now become what? 6,000. This can now become 6,000 shares. So if I had 1 share before, automatically after the stock split, I now have 6 shares. So what I'm trying to achieve is to make my market value constant. Now, what I have explained here, please hold it. is going to become important as we move along, which is regardless of the stock split, my market value does not change. But because I am using a price weighted, if I decline this 500, imagine that, let's just use this analogy that we have here. Imagine that, remember that my price weighting is based on their market prices. So let's say in day one, this guy was, let's just use it, let's just do it here. A, B, C. In day one, this guy was 10 naira. This guy was 5 naira. This guy was 5 naira. That means the total price is what? 20 naira. That means in terms of weighting in day one, this guy has 50%, and these guys have 25 and 25%. Yeah. Now, in day two, this guy does a stock split that by 2 and changes his price to 5. So this guy is now 5, 5, and 5. You can see what has happened. It means that by the time we do our weighting, this guy no more has 50%. This guy now has what? This guy now has what? 20%. This guy now has 33, 33, 33, equally weighting. But anybody that sees this will say, if you don't understand, you say, that means this guy lost money, because for this guy to have gone from 50 to 5 naira, then it means that this guy's price must have dropped by 5%, by 50%. But the answer to that is no. What really happened is that this guy did a stock split. That is the problem with a price weighted index. So we need to account for stock split and monitor the index whenever there's a stock split. Yeah. And what the curriculum said, which you can go and read, yeah, is that anytime there's a stock split, it affects your divisor. Your divisor will change, because what happens is, because of what you have done, it will affect the price of the index. Because like I said, this decline by a significant weighted stock would affect your index. So not to make your index to be affected because of a stock split, when it's not naturally as a result of a decline in price, your divisor needs to change. So this divisor would most likely be what? Be reduced, so that your index would what? Remain at a high level. And going forward, it will now be that your new divisor that you will now be using going forward, not longer what? 5%, no longer 5, which is why I told you at the beginning that your divisor will be used titi lai at that point. However, if you are using a price weighted index where stock split affects it, then what happens is what? Your divisor will change. So I can tell you today that there are two types of stock splits. There's either a stock split where price declines, or a reverse stock split where price goes up. Now, reverse stock split is where somebody comes and says the price of the stock is too cheap. Let us do a reverse stock split. Wema Bank did that last year or 2 years ago. They did a reverse stock split. The stock price was too low. They felt that stock price should be higher. What did they do? They did a reverse stock split, meaning prices now go up. You that you had 1 naira, 1 unit will now have less number of units and all that to maintain that market value. And the reverse to that is your divisor in that case will not go down, but it will what? It will go up. So that, do you understand? Because in that case, it will be as if the index jumped up. But in order for you to balance it out, you have to now increase your divisor when it's a reverse stock split. But when it's an actual simple stock split, your divisor needs to what? Needs to go down. So those are information that you need to sort of understand. And the curriculum sort of has given us evidence with this calculation regarding that, which you can look at your own, at your own time. So moving on, that's the biggest problem with stocks. That's the biggest problem with price index. Yeah. So this guy talks about the advantages and disadvantages. The major advantage of price index is the simplicity. Yeah. But the main disadvantage is that it results in arbitrary weights for each of the security. In particular, it is affected by a what? Stock split. So that's why a lot of people don't like to use this price weighted index. Some people still use it. Like I said, Dow Jones guys use it, but a lot of people don't really like price weighted index. Now, let's move on. Let's move to, sorry, please give me a minute, please. Okay, so the next one is equal weighting. Yeah. Now, equal weighting, they said, is another simple index weighting methodology. And what do we mean by equal weighting? Meaning that if I have stock A, B, C, automatically they will be equally weighted. So that means each person will have 33%, 33%, 3%. If I had a D, they will be weighted as 25%, 25%, 25%, 25%. Yeah. So that's what equal weighting is, and that's what they're saying here. It's still the same, taking us back to what I said here, that if you are imagining that you're calculating return of an index based on this methodology, rather than you using your price, the weighting here, if it is equally weighted, it will be what? Divided by the number of securities that you have. So if I have 10, that means everything here will be 10, 10, 10, 10. If I have 4, 25, 25, 25. If I have 5, 20, 20, 20. If I have 2, 50, 50. If I have 3, 33, 33, 33. I think you guys get the whole logic. Yeah. So that's the trip of equally weighted. Nothing fantastic about equally weighted. It doesn't get affected by stock split, because remember, it only gets affected by the number of constituents that you have. So if your number of constituents change, then it means that your weighting has to change. That's the only thing that changes your weighting. Yeah. But for a price weighted, it is basically based on, as prices change, your weighting also changes. Anyway, so in this case, there's really nothing very particular about this guy. The only thing about this guy is that, like they said here, is in terms of advantage is simple, yeah, but in disadvantages, the first thing is that large stocks would always carry a larger weight. So which is what they are saying here. No, sorry, apologies. Large stocks that should carry larger weights will be underweighted. So let's give an example. So a stock like Nestle, or a stock like Dangote Cement, if you have it in an equally weighted index, Dangote that should have a large weight because of its size would have a lower weight. While stocks like RBG, Prisco, and all those guys that don't really have, that are useless, God forgive me, yeah, that shouldn't have high weightings or shouldn't be significant in your index, would now have what? High weightings. So that's the issue. Number one issue is that there will be a sort of importance segregation, yeah, importance bias. Number two is you'll be constantly rebalancing. We'll talk about rebalancing very soon, but you'll be constantly rebalancing, because at the day you decide that you want it to be equally weighted, yeah, that portfolio will be equally weighted. But from the moment after that, they can never be equally weighted again. And in order for you to maintain that equally weighting, then it means that you need to be rebalancing very often, which is very stressful. Yeah. So another thing again is, I really don't see, a lot of indexes are not equally weighted. Now, this is the master of the game, the one that everybody uses, and the one that is the most prominent, yeah, which is weighting based on market value. Remember how I described how I told you guys how your index is being valued. Remember that it is your total market value divided by your divisor, yeah? And this guy is just telling you that since you're already using this as your sort of your methodology to calculating your value, so why can't you also use the market values to determine your weight? So meaning that by the time you are calculating this guy, by the time you are calculating your return using this methodology, yeah, these guys that are your weights will be determined by your market values, which aligns with what you use to determine the value of the index in itself. So everybody uses market value. And I'll also speak about the advantage of using this market value weighting methodology, which the curriculum sort of elaborated along here. All these, like I said, are just instances that you can read up. Where's the advantages? Sorry, it should be advantages. Or the curriculum didn't write it. Okay, let me just speak to it. The reason why we like to use market value is that even remember when I told you to hold this analogy, this explanation I said here, I told you to hold it very there. Why? Is because remember when I said when a company does a stock split, what they try to do is to maintain the market value. So in the first instance, what we're saying here is if you do a stock split and you're doing market weighting, it does not affect the weighting, unlike a price weighting where it affects. So market weighting is like a superior what's that thing called? A superior methodology to price weighting, or it resolves the issue of stock splits affecting price weighting. Yeah, on that first instance. On the second instance is even when your prices change. Remember the issue with equal weighting. The issue with equal weighting is constant rebalancing. Yeah, is the issue constant rebalancing is the issue with price or equally weighting. Now, the trip about market weighting is that as price changes, it is automatically reflecting in your market value. So hence, the market value weighting changes as market value changes, which is the actual weighting that you should use. So hence, you don't need to constantly rebalance. And that's another reason why people like market capitalized weighting. So stock split does not affect it. Prices change. It's already reflected in your market price, which is what you're using as your weighting methodology. So hence, you don't even have to rebalance all the time. Yeah. So it gives you it shows you the true form. It's already putting your index in already, it's already putting your index in its true form as market prices are changing. However, people like to use what we call float adjusted market cap weighted. I'm with you. Please go ahead. Hello, is somebody trying to say something? Okay, in the absence of that, let me continue. So some people like to use what we call float adjusted market cap weighting. Now, what do I mean by float adjusted market cap weighting? It is not all the stocks. Remember, I told you that market cap. Let's do that. Market capitalization, which is your market capitalization and market value are the same thing. No? The market value of a stock and the market capitalization of that stock is the same thing. So I'm sure probably I'm wondering, I was guessing, I've said market capitalization, I say market value, I did the same thing. They are the same thing. Yeah. So your market value or your market capitalization of the stock is the number of shares outstanding multiplied by its market value, its market price, multiplied by its market price. Now, this is where people use float adjusting as a result of this number of shares outstanding. Some people there's a school of thought that say for most companies, it's not this total number of shares outstanding that actually trades on the exchange. And this is as a result of maybe founding fathers. So a typical example is Dangote Cement now. It's Dangote Cement shares. Mr. Dangote, Alhaji Dangote shares, I am very sure doesn't trade on the exchange. I don't even think those shares have been if I might try to be very funny, I don't even think those shares have been dematerialized. Yeah, meaning that they are probably still in certificate form. Anyway, they don't trade. So some people are saying, so why do we incorporate them into our market capitalization weighting? Why don't we remove those stocks that we know, those number of shares of the constituents that do not actually trade? And that is what we call float. So float means the portion of the number of shares outstanding that actually trades on the exchange. That's what we call market float. So some people are saying use the market float to determine what your market capitalization weighting is. It's not a bad one, but it still passes the same message. It's just that some people might have higher floats than some. Even though let me give an example now. GTB's float would definitely be higher than Dangote Cement float. But Dangote Cement has a higher market value than GTB. So by the time we do float adjustment, the market capitalization or the float market capitalization of GTB will most likely be higher than the float market capitalization of Dangote Cement. So that's what they're trying to achieve. Let's see the true sense of what is happening in the market. Yeah. Okay. So that is the okay. I think yeah. This is where they talked about the advantages and disadvantages of the market cap. So they said the primary advantage of market capitalization weighting is that the constituent securities are held in proportions to their value in the target market. So it is what it is. It is what you see, is what you are using. There's nothing is distorting anything. Yeah. The primary disadvantage is that the constituent securities whose prices have risen the most have a greater weight in the index. Yeah. The weighting methodology leads to overweighting stocks that have risen in price, which, if you think about it, that is what has happened with Seplat. Yeah. So Seplat has significantly increased in price over the years, even though, you tend to wonder what is causing this price increase and all. And you see Seplat becoming more valuable than a lot of other companies that are even doing better than it in terms of performance. Yeah. Then another instance is a company like Boa Foods that just got listed like 2 years ago and has significantly increased in price. And as a result of that, the market capitalization of Boa has become one of the biggest, maybe top 4 already, say, or top 5 in the market. Yeah. So we see a lot of such situations happening all the time. Yeah. So those are the advantages or disadvantages of market cap. Now let us move to the last one, which is fundamental weighting. This is the funniest of them all. Yeah, I'm sure somebody will be wondering, bros, why do you say it's the funniest? It's the funniest of them all because what you are using here to weight is not market cap, is not price, is not equal weighting, is a particular feature of the stocks or the constituents. So you can decide to say that you want to use PE ratio, yeah, to sort of weight. You can decide to say you want to use sales value or profit after tax to sort of weight. It's an interesting one, but we see a lot of people wanting to do this type of weighting. Yeah, but like I said, it's not very predominant. The most predominant method of weighting is your market capitalization weighting. Now, moving on. If there are any other questions, we're done with that aspect which has to do with weighting. So if we go back to our 5 questions that we had at the beginning as regards construction of an index, we have at this point been able to answer 3 out of them. So we've done these 3. So let us move to these 2 in the absence of any questions. Thank you very much, guys. So moving on. So the next is rebalancing, and I've mentioned what rebalancing is. So I like this. They've brought it back for us to sort of, so that we don't have to start going back. So when you hear index rebalancing and index reconstruction, they are 2 different things. Yeah. Rebalancing means that the weighting that we talked about now has changed as a result of changes in prices. And because we want to maintain that weighting that we want, in an instance, equally weighting, yeah, because we want to maintain the equally weighting, what do? We have to sell some shares and buy some shares. So basically, what that is that we need to sort of take the portfolio, or sorry, take the index back to the actual position that we want it to be. That is what we call rebalancing. And most indexes always have what? Rebalancing policies. Yeah. Now, the next is reconstruction. Reconstruction, like I said, is when some constituents do not meet that selection criteria or the parameters that you have set at the beginning to determine stocks that are meant to be in the index. Yeah, so it is what I said. Reconstruction is the process of changing the constituent securities in an index. And the reason why you do that is because they probably don't meet that criteria or those parameters that you have set. So what do? You yank them off and you bring the new guy that comes into the index and you communicate to the market. So a typical example is if I'm telling you that the S&P 500 constitutes, the constituents are the top 500 stocks. Imagine a stock that is number 500. There's no possibility that by 6 months' time, it will still be number 500. It might probably have depreciated in price that the guy that is number 501 can sort of, not even 501, the guy that might be probably number 505 might have also appreciated in price to such a point that it knocks this guy off and it becomes number 500. Or might even rise to a point that it's not even number 500. It might now become number what? 460. Yeah, and as a result, some people have to be what? Let go of the index. So that's what we call index reconstruction. Now, most indexes would give you information. Most index providers are those guys that create indexes. Yeah. So most index providers would have given the market some level of heads up as regards when they will do their reconstruction, so that it doesn't hit some people unknowingly. Is that the right word to use? Doesn't hit them unannounced or unexpectedly. Yes, that's the right word. It doesn't hit them unexpectedly. So they always tell people that every 6 months or every beginning of the year, they do some sort of a reconstruction. So market participants can look forward to it. Yeah. Yeah. So that's that on rebalancing and reconstruction. Now, let us now move to uses of market index. Uses of market index. Remember, I told you at the beginning, we need to look at why do people need market indexes? Why do people use market? What is the essence of market index? Yeah. Why are people fixated on market indexes? So it talks about uses. Yeah. And remember that I told you that beyond the paramount use or essence, which is performance, to determine the performance of a market or a particular market segment. Yeah, we also have what we call gauge market sentiment, and that's basically what you see on CNBC. Yeah, so at times they will tell you, oh, the market is bullish. How do you know that the market is bullish? How do you know the market is bearish? The market is bullish because they can see that over a certain period of time, yeah, that triangle that you have been seeing has always been green, day in, day out. Day in, day out. And the only way they can do that is by monitoring the market index. So they've monitored the market index, let's say over 10 days. And every day, that triangle is always green, always green, always green. Then they come and say, oh, the market is bullish. And that is saying that the market is bullish is you already talking about market sentiment. A bullish sentiment. Everybody in the market is happy. Yeah, and that's why we're seeing greens all over the whole place. Yeah, so it's a gauge of market sentiment. Number 2 is proxies for measuring and modeling returns, systematic risk, and risk-adjusted performance. Remember what I said, performance. One of the major reasons why we use indexes is performance measurement. And we use indexes in order for us to be able to determine performance. Yeah. So when we move to portfolio management and we talk about CAPM, yeah, you would see how what I have spoken here will jump at you, because at that point we'll be making a lot of information around market. And what should come to your mind when you start hearing market is most times we're talking about what market indexes. So because some people use market indexes as proxies for what they call the market or the market portfolio. Yeah, it becomes clearer when we get to CAPM. Now, proxies for asset class in an asset class allocation. Yeah, so there's something we call asset allocation. Now, when if you go back to my last reading, on that reading I did on portfolio management, when I talked about the things that you do under the execution step, remember we talked about asset allocation, security selection, and portfolio construction. So under the asset allocation, we have what we call asset allocation models, yeah, that we use to determine their asset allocation. So what people do is that they use they use market indexes that represent asset classes as inputs into the asset allocation model. Yeah. So a typical example is if I'm looking at how a company would allocate its assets again between real estate, fixed income, bonds, and equities. What I would use as an input into that model is a market index that focuses on real estate, a market index that focuses on equities, and a market index that focuses on bonds. And I put that information into the model, and the model will tell me how I should allocate my portfolio. That's acting as proxies. Now, the next is benchmark for actively managed portfolio. Now, what is an actively managed portfolio? An actively managed portfolio is a portfolio where the portfolio manager wants to outperform a particular benchmark. Yeah. Now, what is that benchmark? Most times, that benchmark, we always proxy towards a market index. So your ability to beat S&P 500, your ability to outperform the Nigerian All Share Index, your ability to outperform the FTSE 100. Those are, so in that case, what we're just trying to say is your benchmark is actually the market index. Yeah. Then lastly is model portfolios for such investment products as index funds and exchange traded funds. Index funds. Okay. Anyway, let's move on. I just had an eureka moment. Okay. So what are we saying here? What we're saying here is that most times when we want to create investment products like ETFs or index funds, we need to replicate a particular market index. Yeah. And if there are no market indexes, these products would not come to life. So they are very essential in that world where you need to create this sort of investment products. We need to replicate a particular market index. So yeah, so that's everything I have explained. Yeah, everything I've said is what they've explained here, they've explained here, they've explained here, and they've explained here, and they've explained here. So beyond this, what did the curriculum now do? Beyond this, what did the curriculum now do? So what the curriculum did is to now give us different types of market indexes. Yeah. So under equities, you have broad market indexes, which is the typical example is the MSCI World Index that I mentioned. Yeah. The MSCI World Index. So this is an index that covers the whole world. Or you can say broad market index. Another one again is the Nigerian All Share Index. So that is an index that covers all the stocks in the Nigerian Stock Exchange. So you can have indexes that are this broad under equities, or you can have multi-market indexes. Sorry, A typical example of multi-market index is, let me take my words back, is the MSCI World Index, meaning an index that looks at more than one market. That's the MSCI World, yeah, which is what you have somewhere around here. You can see MSCI here. So the MSCI World is another type of index, but a broad market index is like the Nigerian Shore Index. In America is the Wilshire 5,000 index. It's another one that is like covering. So when you say a broad market, a market, an index that covers all the securities in that particular market, there's no segregation. While multi-index is looking at two different kinds of market. Yeah. Now we have sector indexes too. Yeah, so indexes that focus on sectors. So in Nigeria now we have something called the NGX Banking Index. It focuses at only banking stocks. We have the Consumer Goods Index, focuses at only consumer goods. We have Insurance Index that focuses only on insurance companies. Yeah, so these are what we call, so sector indexes just focuses on a particular sector within the market. Yeah, okay. Now, moving on is we have what we call style indexes. Yeah. So indexes that focuses on style. And when you hear style, what we talk about is either value stocks, growth stocks, or a combination of both. Yeah. Or large cap stocks, small cap stocks. So another example, S&P 500 can technically be called a style index because it focuses on only large cap stocks. So when I say the top 500 large cap stocks predominantly, yeah, so you can say that's the style index. So your style can either be based on market capitalization, that's where we talk about large cap, small cap, mid cap, or it can be spoken from a value and growth orientation. So we're looking at only value stocks, or we're looking at only growth stocks, or we can combine both, where we have large cap value, mid cap value, small cap value, large cap growth, mid cap growth, small cap growth. So a combination of both. So style, combination of both, or you can either focus on market cap, or you focus on what I like to call this orientation, or focus on orientation where you are looking at only value or growth. Okay. Moving on. Now let's talk about fixed income indexes. Yeah. The issue with fixed income indexes is construction. There's a big problem with fixed income indexes. There are not a lot of them because constructing it is challenging. Do you know that the bond index is bigger than the equity market? A company can have different bonds running, but a company can have only one stock running. So I can have a 5-year bond, a 10-year bond, a 20-year bond, a 2-year bond, a 1-year bond, all over the whole place. A 50-year bond, a perpetual bond, all over the whole place. Please hold on. So yeah, so that's the issue with construction of an index. Another thing again about an index of fixed income index is that fixed income indexes, bonds mature. So after they mature, they are out of, that's the end of, so there's a terminal thing to bonds. Yeah. And as a result, it's also making it challenging. So what are you focusing on? Are you focusing on maturity? Are you focusing on company? Are you focusing on, it's just all over the place. Yeah. But some people have been able to create bonds or fixed income. Let's say predominantly, when you say fixed income indexes, predominantly bonds. Yeah. Some people have been able to create bond indexes through some certain different methodologies, and they've been able to achieve them. Yeah. So they've been able to categorize their indexes based on type of issuer. So is it government? Are we only looking at government bonds? They've been able to tie them and also categorize them based on types of financing. Is it general obligation, collateralized? They've been able to, based on currency of payments, dollar bonds or naira bonds or euro bonds, or all that. They've been able to categorize based on maturity, credit quality. So like I said, different ways of categorizing bonds, which makes it quite challenging. Yeah, but we've been able to do broad market indexes, just the same way, market sector indexes, style indexes, and all that for also fixed income. A lot of people don't really talk about fixed income. This is only, for my own sense, this is the only most prominent fixed income bond, prominent bond index. Yeah, really, in the whole world. Okay, so you can see what is happening here. So there are different dimensions. If you want to look at it from market, if you want to look at it from type, if you want to look at it from currency, if you want to look at it from credit quality, it's a big one. It's a big one. Big complex stuff. Okay, so do you have indexes for alternative investments? The answer to that is yes. So we have some commodity indexes. Yeah, those are more specialized. It's like a more specialized aspect, yeah, of indexes. Yeah, so we also have commodity indexes. We have real estate indexes. I just mentioned it now. Rates and all that. Yeah, rates that are focused on rates. Yeah, so we have real estate indexes too. Yeah, so we have hedge fund indexes. You see all these things in your alternative investments. You see them all in your alternative investments. So yeah, those are indexes for you, and that's security market indexes in a nutshell. I think the major part of this reading that you should focus on is that first part. I'm going there now. Just give me a minute. No, obviously, you have to understand the uses of market index. You have to understand the uses of market index. Very, very, very very important. So you can just say a question in the exam, which of this is not a use of market index? And if you don't remember this, you'll not be able to know which one of them is not meant to be a use. Yeah. So you need to understand the weighting methodology. Yeah. So we have price weighted, equally weighted, market cap / float weighted, and we have fundamental weighted. So you need to understand those guys too. Then moving on, I'll be just doing a recap. Then obviously you need to understand how to determine, if you can, how to determine the value of an index, how to determine the return on an index, and at least you need to understand what this is. If you can do all those three, I think you are in a good place with this reading. Any questions? Any questions? Any questions? Any questions? Okay. In the absence of any questions, can we take like a 30 minutes break?